All right, everybody, welcome back. Today we're going to talk about SPY max pain. So, what is SPY max pain? This is an old school market logic that focuses on the idea when it comes to options that dealers with their hedging dynamics would force price to the place at expiration that would cause options holders the most amount of pain. So, we want to look at SPY max pain today and visualize this in a graph. We've got options charts IO. I'm just randomly picking one here, and we can see max pain for today, January 21st. And here's the visual of what that would look like. And it's telling us the max pain is 590. Now notice I didn't sign in. I don't have an account here. I just randomly picked a site. Here's another one, maximumpain.com. And again, it's just going to calculate this for us. We can see when it was created, the current price, the max pain, and we would want a date on this right here, the 21st. So just like that, right? And if we scroll down, I'm sure they'll have a visual. There it is. There's the max pain. It's a very common visual. Most of the websites you see are going to look like this. It doesn't cost you anything to do that. And the idea behind all of it is trying to identify, due to dealer hedging dynamics, where price is likely to pin at expiration, all predicated on the idea that the dealers, being the net short group, would cause the most financial pain to everybody else who is net long. This really is an old school concept. In the modern world, we focus on dealer hedging dynamics, GEX, call walls with put walls, and that leads us to absolute gamma, zero gamma, and max pain really just isn't even a concept anymore. Still, if you wanted to calculate this on your own, there is a formula for it. So you don't have to go to those websites if you don't want to. You would choose your expiration, and then first, for each strike, you would look at the stock price and you would look at the difference between that and the strike. So we've got, 590, if we want to round up, 598. And then we've got, 605, 598, and 604, 598, and 603. You kind of get the idea. For each strike, you would calculate that difference. And then for each strike, you would multiply the value that you have calculated above the open interest. All right. So if we have 598 and 600, then we've got $2. We would multiply that $2 by the open interest. And then we would sum that up by the dollar value. And we would do that on every single strike, on the calls and on the puts. And we would try to find the highest and the lowest values. And what it would end up forming is that graph or that chart that we were looking at with that curve on it, so that it looks a bit like that grid or curve or chart. You don't have to do that math, however. You can just go to the website like I showed you and visually look at it. You can look at this on other products, but it needs to have a lot of open interest, on the assumption that if dealers are in their hedging, then we should see them. There should be a large amount of dealer positioning there and likely cause price to pin. Now, going far out in time really isn't going to give you much benefit. You really want to focus on the short-term expiration stuff. SPY has an expiration every single day. And so if you are looking at SPY open interest and SPY options volume, and you want to calculate SPY's max pain, I would focus on the day of. Now, we can always get ahead of things, right? So at some point through the trading day today, you may start considering where max pain is for tomorrow. That would make perfect sense. But going out 10, 12, or 18 days, that doesn't make a lot of sense. And then, of course, it is always important to realize that other products don't have an options expiration every single day. So if you're looking at something, say, like Tesla, which had over 4 million options contracts traded on Friday, That's certainly a lot of volume and it has a lot of open interest. We could look at max pain for Tesla, but it has an expiration every Friday, not every single day. You do want to compare those Friday to Friday expirations against the monthly expiration and just focus on the one with the largest grouping. So let's go to Tesla just for an example, really quick, and discuss that. The February 21, that's the monthly expiration. And we can see the front end here. Well, there's no comparison whatsoever, right? The one in the front, 13,000, 12,000, 14,000, 18,000, and every single strike has a lot of positioning. If we go out to the monthly, it's really small. It's skipping every other strike, not a lot of positioning. So it's not an issue. But when we get most of the way through January and we're halfway through February, then it may be beneficial to compare it against that monthly and make sure that the monthly isn't the dominant options structure at that point. Otherwise, using the front end is generally going to make the most amount of sense because what we're trying to identify is dealer hedging dynamics that would force price to the max pain spot. So SPY max pain is a concept that came out in the early 2000s. We're talking, 20 plus years ago, and combined a total of 25 years ago. So much has changed since then. The institutions and funds and firms that trade now in size, in bulk, are completely different. The tools that we use now that can help us visualize these different players, the commitment of traders report, really large options products like black box stocks, cheddar flow, spot gamma, all of these tools help us identify the different players out there, their size, and the hedging dynamics that are employed in this modern world. All of this logic with the SPY max pain comes back to dealer positioning and dealer hedging dynamics. So we want to focus on anything that can help us identify their positioning. Now, one thing about SPY max pain that I got hung up on is the idea that dealers can drive price to a particular expiration. So that's what I got for you guys. SPY max pain, what it is, how to calculate it, and how to see it. Appreciate your time and look forward to seeing you at the next one.